Let us take a look at this problem. This is one of the advanced capital budgeting problem, which is used to be part of a topic called as simulation in QT, quantitative techniques. Andha kalathil, that is in those days old syllabus. When I was doing it, it was part of a topic called as QT. Costing and QT, we used to have it. Then it became advanced management accounting. Then it became strategic cost management, and now that subject is there in your uh, what do you call self-paced module. In that process, this topic got eliminated. They have introduced it in advanced capital budgeting, Monte Carlo simulation technique. It's basically about looking at probability approach. You know what is the thing of probability? By looking at the past, converting into a ratio the frequency of events, that's called as probability. Like in the last 10 instances, 3 out of 10 instances you are able to reach the office in 30 minutes. So the probability of reaching 30 minutes is 3 out of 10. So looking at the history, looking at the frequency of events, that is called as probability. And we are going to estimate the future value based on that probability is Monte Carlo simulation technique. So what is that Monte Carlo simulation exactly? It is with the help of running a random trial runs. We call it as something called as random number table. So how are we going to calculate that probability? How are we going to make use of that random number? Let's take an example what Institute only has given in the form of this Monte Carlo simulation technique, that is on the topic steps in simulation analysis. We have this example. I have also included this in my material. Let me just simply go through the Institute numbers only for understanding the concept. Let's read it. I is equal to 10% rate of interest. I is 1,30,000 capital I, so that is investment 1,30,000. Cash flow and stochastic exogenous variables, basically the variable factors, functions, parameters with the following will be as under. So annual cash flow. So here comes the probability approach. So annual cash flow can vary. It can vary from 10,000 to 40,000. It can be any number. It is uncertain. And we have associated a probability with, which will be given in the problem. So cash flow, so there is 10,000, there is 2% probability, 0.02 probability that the cash flow is 10,000. And similarly, there is 0.15 probability that there is 40,000. Like that, we will have different cash flows with different probability, based on which when we applied the probability approach, we got expected cash flow. Similarly, project life also we have got different numbers. There is 0.05% probability, 0.05 or 5% probability that project life is 3 years. Or there is 25% probability that project life is 6 years, like this. 10 manual simulation runs are performed for this project. 10 manual simulation means 10 times we calculate the NPV of the project. Each time the cash flow may be different, the project life may be different. That is ascertained by the data from the simulation table, the random number table. 10 times we are going to run. So 10 times we get NPV. Each time cash flow may be different and project life may be different. So cash flow we know, annual cash flow. Discounting factor 10%. So using that we can get the present value of inflows. And to get the present value, rate of interest is 10%. But number of year is uncertain, for which again we have the project life. So cash flow into annuity factor, that will give you present value minus investment is the NPV. So 10 manual simulation are run performed for this project. To perform this operation, values are generated at random for the two exogenous projects, annual cash flow, variables, annual cash flow and project life. For this purpose, we do the following steps. Set up correspondence between the exogenous variables and random numbers. Choose random number generating device. So we run a random number. We have 2 digits probability, so we go with 2-digit random numbers. So what we do, it's like rolling a die. Take a random number out of it. Of course, rolling a die is not 6 possibility here, 0 to 100. Suppose if it is 72. So I got random number 72 and I see where this 72 will fit in and corresponding cash flow I will take. Again, I throw a random number. Suppose that is 70, that is 31. In the project life, I look at the interval corresponding to this 31 random number, which year is one, I will take that, and then based on those two outputs, I will calculate NPV. Now the question is, how do you calculate the table? That is what we are going to call it as cumulative probability. How do you calculate the cumulative probability? Cumulative. You keep on adding. You start with 0.02. So you start with 0.02, right? Then 0.02 plus the next probability, which is 0.03. So 0.02 plus 0.03 becomes 0.05 plus the next probability. So plus 0.15 becomes 0.20, like that. You keep on adding. That is called as cumulative probability. Similarly, you do for project life. 0.05 is start, then plus 0.10. 0.1 plus 0.05 is 0.15, plus 0.3 is 0.45, and so on. So let's see if the answer is correct. So 0.2, 0.05, 0.20, and 0.05, 0.15, 0.145. So that's what they have done here. So take a look at the institute solution. Annual cash flow value, this is given. Probability is given. Cumulative probability is calculated by adding the probability, just like the way I told you. Now, project life also, value is given, probability is given. Cumulative probability is obtained by adding the probability, like I told you. And while adding probability, you can do one quick thing, that is, anyway you have cumulative probability, right? Say for example 0.02 you got, plus 0.03 you got 0.05. Anyway you have got, you don't have to add from the beginning again. Anyway you added earlier 0.05 plus 0.15. So you got 0.02 plus 0.03 as 0.05, and now you already got 0.05. You can add 0.15, you get 0.20. So cumulative probability, you already got it. Keep adding the next one, you will get the next cumulative probability. So you got both the tables except for this random number digit. I told you, right? We throw a die and we get the random number and we fit into the table. That table is this column. So how do we get this column? Let me tell you. Let me tell you for project life. See, probability, cumulative probability column you take a look at is 0.05. So it will start from 0, it go till 0.4. 0.05, take a previous number. Previous number is 4. So 002, 04. Then you take the next number, 05 next number, 04 next number is 05. So 052, last number 15 take the previous number, that is 14. You got it right? So here we got 15, so it is 14, 45, 44, 70, 69. Last one therefore must be 99. 2-digit random number obtained by using cumulative probability. Cumulative probability, if it is 0 to 0.09, then starting is 0. Don't take 09, take one number before that, that is 8. So next interval, start with 9, and it was let's say 0.09, or next probability is 0.15. So you start with 9, don't go till 15, take previous one, 14. You got the logic, right? So it is 0.02, start with 0, before 2, that is 1, so 0 to 1. Next, start with the next number, which is 2. What is the next probability? Which is 3, 0.03, sorry, 0.05. So 5 you have. What is the number before 5? That is 4. So 02 to 04. Then we have 20. Start with 5. Then 20 before number 19. The next 35. So start with 20 before 35, and that is 34. Next number 65. Start with 35 because that's for 34 ended. Start with 35, and that's what this number 0.35. So next number start with 35. 65. Previous number is 64. Next number is 65 starting. 85 before number, that is 84. Next start with 85, last one is 1, and 1 before number is 99, so 85 to 99. So I hope you have understood how to calculate cumulative probability, and from cumulative probability you calculate the random number interval, 2-digit random number interval. Now this random number table will be given in the question. That will be given in the question. Random number will be given in the question, or from the random number you can draw it. But as the name suggests, when it is random number, everybody's answer should be different because it's random. But if everybody's answer is different, how an institute can evaluate the answer? So they have given you this random number generation table. Okay, so if everybody takes different random number, institute cannot value because everybody get different answers. So in the exam, they should give you the random number. Like they should give you something like this. Okay, for simulation 1, because they said 10 simulation are done. Simulation 1, random number will be 17,92. That means 17 is for cash flow purpose, 92 random number is for annual project life purpose. Simulation number 2, it is like 32,51. So 32 is for cash flow purposes, 51 random number is applicable for project life. So in the exam, they should give you the random number so that everybody has same number and institute can evaluate. But in the given situation, they simply given the random number. So you have to choose at random. Like for example, what institute has taken? 53, that number they have taken, that is like 53, the first number, and 97, second digits. They have given so many numbers, we take only first 2 digits. So 53 is for the cash flow, then 97 and next number, random number, I will take it for the project life. So how do you select? Once I do random number, which is randomly, in the exam they should give you this random number, they can't leave it for you to select. They will give you the random number for each simulation trial. So once the random number is known, like in this example 53, what you do? You go back to that random number interval. 53. So look at this interval and say, where does 53 comes? 53 comes between 35 to 64. So corresponding cash flow is 30,000. So That's what they have taken. Corresponding cash flow, sorry, 30,000, no? Oh, they have given 3,000. No, 30,000. That's a typing mistake. This is not 3,000. It's a typing mistake. 30,000. Yeah, 30,000. Then number of years. For that 97, second random number you have taken 97. Same approach. Go to the table of project life. Where does 97 comes? 95, 27. So 97 corresponding number. We have project life of 9 years. So now we are going to calculate the simulation number 1 with the cash flow of 30,000 and number of years of 9 years, you calculate NPV. So you see they have 10 random number 53, cash flow of 30,000, then random number 97, cash flow of 9 years, you calculate the annuity factor. How do you do annuity factor? 10% is the rate of interest, 1 divided by 1.1 equals to how many times as number of years? 9 years. Then you press GT, that will give you the annuity factor. You calculate NPV, that is cash flow 30,000 into annuity factor 5.759, 30,000 into 5.759, that is present value of inflows minus investment is 30,000. That's what they have given. 1 into 2, 1 is cash flow, 2 is annuity factor, 1 into 2, cash flow into annuity factor, 30,000 into 5.759 will give you present value of inflows minus NPV, you get minus investments 1,30,000, you get NPV. Like this you have to do total of 10 runs. Second run, they have taken random number of 66 and 10. Like they have taken some random number of 66 and some 10. Any random number you would have taken from this table, any 2 digit. The 10 seems not to be here anywhere, but they have taken. Anyway, so 66 and 10. So what is the corresponding one? Go to the table. Where is 66? 66 is 65 to 84. So cash flow is 35,000. And 10 for life. 10 is 5 to 14. So life is 4 years. So 35,000 and 4. So 35,000. Sorry, random number is 99. I'm sorry, random number is 99. 66, 99. So they have taken here 66 and 99. So they have taken the two digits. You got it right? 53, 97, 66, 99, 30, 81, 1909, like that. 1909. They have taken the two digits. But that need not be the case. Because random number means you can take any random number, but in the exam they should give you the random number which you have to take. But what they have taken now, you understood, right? They have taken the first number for cash flow, second number for annual life, the project life. Second number again, the first number, sorry, again 66 is for cash flow, then 99 is for project life. So 99 comes here, 99 is between 98 99, which is 10 years. So 35,000 cash flow and 10 years. 35,000 cash flow and 10 years. So 35,000 multiplied by annuity factor. Annuity factor is 10 years. So 1 by 1.1 equal to 10 times, then GT into 35,000, that is cash flow minus investment 1,30,000, you get NPV. Okay, so that's how you get the NPV under different simulation trials. So that's how we calculate for each simulation different NPVs. Then based on this we can do further analysis. What is the average NPV of this? What is the standard deviation of this? We can make some analysis around it. But they have not asked. So this is the running simulation trials and see whether you get the positive NPV in most of the cases or not. So I hope remaining part you can calculate. I have used only the institute material example. Hope you are able to calculate further. Great.